Alibaba, ticker symbol BABA, currently trading on the New York Stock Exchange, is trading at $218.56 per share with a market cap of $592.62 billion US dollars with a PE ratio of 25.59. It's down from its 52-week high of $319.32, but it's slightly up from its 52-week low of $204.39. Over the past month, the stock has traded down around 4.1%, and over the past 6 months, it's down a whopping 18.22%. Year, it is down, or it's actually trading flat 0.24%. Is Alibaba a buy? This is going to be the BABA stock analysis, StockerFinance. I'm your host, David Shore, twitter.com/StockerFinance for more information. Newsletter link below if you want to subscribe and check that out as well. So it's a declining stock, but a growing company. And we're going to check this out here. Revenue actually grew an increase of 64% year over year. On top of that, that's also excluding the consolidation of Sun Art. With that, it would have grown 40% year over year. And on top of that, with mobile monthly active users on their China retail marketplace reaching 925 million in March 2021, an increase of 23 million over December 2020. So almost a billion individuals are on their China retail marketplaces. If we look at the revenue again here on this summary of their financial results, and this is on a quarterly, this is on their quarterly report, by the way, their most recent one. But year-over-year increase, as I said again, of 64%. EBITDA also increasing, adjusted EBITDA increasing 18%. And adjusted EBITDA there increasing 14% respectively, with non-GAAP income up 18% year over year, 3 months ended March 31st. Now, if we look at their core commerce and we break it down into segments here, you can see that the retail marketplaces had 925 million mobile monthly active users, as I stated previously. That's representing annual and quarterly net increases of 79 million and 23 million respectively. 811 million annual active consumers on our China retail marketplaces for the 12 months ended March 31st, 2021, representing annual and quarterly net increases of 85 million and 32 million respectively. In the fiscal year 2021, approximately 70% of new annual active consumers were from less developed areas. And that's because they've really been focusing and had a strategic focus on less developed cities and towns, which is going to broaden their offerings of products and services to meet diverse demand. So overall, online consumption goods, including unpaid orders, grew 21% year over year in fiscal year 2021. That's driven primarily by the fast-moving consumer goods and home furnishings categories, and 33% year over year in the March quarter, driven primarily by the apparel and home furnishing categories. For the March quarter, Tmall online physical goods GMV, including unpaid orders, grew 26% year over year, and Temu online physical goods GMV, excluding unpaid orders, grew even faster as SME merchants recovered from the pandemic. So great growth so far from this report here. In 2021, their cloud computing revenue, which has drawn a lot of attention, grew 50% year over year to I'm going to say this in US dollars actually, $9.176 billion US dollars. That's primarily driven by growth in revenue from customers on the internet, public sector, and finance industries. In March 2021 quarter, cloud computing grew 37% year over year to $2.558 billion US dollars. Slower revenue growth during the quarter is primarily due to revenue decline from a top cloud customer in the internet industry. The customer, which they are not stating here, has a sizable presence outside of China that used our overseas cloud services in the past, has decided to terminate their relationship with respect to their international businesses due to non-product related requirements. Excluding these customers, Alibaba's cloud's top 10 non-affiliated customers together accounted for no more than 8% of Alibaba Cloud's total revenue in fiscal year 2021. Going forward, we believe that our cloud operating computing revenue, blah, 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 blah. We don't have to read the rest of that statement. But yeah, anyways, they're basically just saying there they experienced great growth despite losing that customer. It's not a huge percentage of their overall revenue for their business. So losing that customer is not a very big deal to this customer. And I completely agree with that. It's not going to drastically affect their bottom line. As long as that trend doesn't continue, we don't start to see more companies follow the route of that one company, whoever it was. Clearly, it was a pretty big player. They decided to leave Alibaba's cloud computing business. They no longer wanted that service for whatever reason. As long as others don't follow that company, go on the same trend, Alibaba's looking at great growth in its cloud computing, even if it slowed down slightly the previous quarter. Now let's look at the digital media and entertainment. So 35% year over year during the first quarter. That is the average daily subscriber growth rate there. A very healthy rate. The increase in paying subscribers driven by offerings of original and exclusive content. They invested in original exclusive content while ensuring cost efficiencies and return on investment, which resulted in narrowing the annual adjusted EBITDA losses year over year in fiscal 2021. Let's look at their share repurchases as well. They repurchased approximately 1.7 million of their ADSs, or approximately 13.6 million of ordinary shares. That was for approximately 371 million US dollars under the share repurchase program. So they're buying back shares. Their revenue's growing. Their monthly active users across multiple of their platforms are growing. Cloud growth slightly slowed, but it's still growing respectively. And cash flow from operating activities and free cash flow also grew, an increase of 28% in the fiscal year 2020, or compared to the fiscal year 2020. Free cash flow in a non-GAAP measurement of liquidity increased 32% in fiscal year 2021 compared to 2020, mainly due to their profit growth. If we look at cash flow from operating activities and free cash flow here, net cash provided by operating activities was approximately 35.378 million, an increase of 28% compared to 2020. Free cash flow, a non-GAAP measurement of liquidity, increased 32%, and we already touched on a lot of this, and that's mainly due to profit growth there. Now let's take a look at their guidance here. Their guidance, they also have experienced strong guidance moving forward. They expected to generate RMB 930 billion in revenue. If we convert that to US dollars, and that's for 2022, it's approximately 142.42 billion US dollars, and that's around a 24.71% increase in revenue year over year compared to 2021. Now, if growth is solid, guidance is great, as we saw, and the fundamentals are healthy for this company, then why is the stock trading so sideways? Again, it's only at 0.24% year over year, and it's really declined over the past few months here. We said about a 20% decline over the past 6 months. I mean, the stock has really not shown the same growth that we'd expect. Obviously, the Ant Group deal didn't work out as intended, but even without that, which caused a major decline in the stock, we would expect some growth in the stock just due to the growth of the company's revenue overall. So why is it trading sideways? Well, a lot of it has to do with regulation and fear of what's going to happen with the U.S.-China relationship. Recently, we have Biden expanding Trump's list of Chinese companies banned from U.S. investment. Previously, we had Trump threatened to take multiple companies off the U.S. stock exchanges. One of those was Alibaba, although it got removed from that list. I don't believe it's going to happen, though, because Alibaba is such a massive player and is so involved in business-to-business relationships, especially with companies such as Amazon, where Alibaba is one of the primary suppliers to individuals who then sell those products on Amazon. I'm sure you've heard a lot of the drop shipping stuff going on whatever it is. But anyways, they are an important player in the United States, especially for cheap goods coming into it, importing into the United States. So yeah, I don't think Alibaba is going to go anywhere soon, or I don't think it ever will actually off the U.S. stock exchanges, but that does create a fear, and especially with regulation as well, such as investment regulation here, it creates a huge fear among investors that is driving the stock down and creating lots of downward pressure on the stock right now. And on top of that, ADSs just tend to trade at lower multiples due to higher implied risk, especially when you're dealing with Chinese companies that have a history, let's say, especially with the Lupton coffee scandal, of not reporting their financials accurately, and that creates a lot of controversy over those companies, and it creates a lot more skepticism from investors, especially institutional investors who aren't dealing with a few $1,000s of an investment. They're dealing with millions and millions, even billions of dollars invested into these companies. So that's something that is, definitely resulting in some downward pressure on the stock, even despite great growth and great fundamentals from what they reported. I mean, here's an example. Amazon, a very similar company to Alibaba, is trading at a PE ratio of 60.93, more than double that of Alibaba's PE ratio, despite being very similar companies in very similar industries. JD.com is another Chinese competitor to Alibaba. As you can tell, you're a very low PE ratio. It also is an online marketplace similar to Amazon, and it has a PE ratio of just 14.8. It's also an ADS here. So what is the price target, and when will the stock reach it? I haven't really touched on what I expect the stock to reach, and I haven't really given a time frame either. We just know that there's great growth, but the stock is experiencing a lot of downward pressure due to multiple, let's just say, geopolitical reasons and domestic reasons involving politics. So here's an article from Seeking Alpha here. It's a great article. I'll go ahead and link it in the description below if you want to take a look at it, talking about a $500 price target over the next few years for Alibaba. But again, this is on a very long time frame, not a short time frame. And when I mean long time frame, I'm not talking about a year or 2 years. I'm talking about probably 3+ years for this company. However, a $300 price target seems very achievable, and I completely agree with this article. Credits to the author here. Again, I will link it in the description below if you want to check out this article. I definitely agree with the author here that $500 could eventually hit, but I think $300 is more reasonable in the shorter term. So if Alibaba were to generate earnings per share of $20 at some point and traded at an earnings multiple of 25, which is currently trading at just about, then shares would trade at $500 per share. If Alibaba were to generate earnings per share of 25 and traded at 20 times the earnings multiple, then shares would trade at $500. I personally think the earnings multiple will trade at around 25. 30 would be quite high for this company. If Alibaba were to generate the earnings per share of 17 and traded at 29 times its net profits, its shares would trade at marginally below $500. Now, let's go ahead and look at its earnings per share right now, currently at $8.49 on a basic basis. And if we look at that here, it's currently, it has weak performance in terms of its stock right now. But again, we're experiencing lots of growth with this company. And I agree with the author here again, as I've already mentioned, that is rather a result of multiple compression and a downward pressure on the stock, which is driven by, low investor sentiment as well as skepticism from investors due to China exposure and fears about regulation and other political reasons. So at its current price of $200 and I believe it was $18, Baba trades at a quite large discount compared to the current consensus analyst target price of $298. If Alibaba were to hit that, shares would gain 35%. We can see here the 1-year target estimate is $295.37 a share, significantly above the $218.34 mark that is currently trading at as of this recording. So with a 1-year time frame, if the analyst community is correct, Alibaba could be a great investment. I mean, that's, around with this valuation. It doesn't seem too outrageous. At $298 would equate to around a 29 times this year's expected net profits or 23 times next year's net earnings. If this does happen, if it does go to $295.37 a share within a year, that's around a 26.1% return from the current price. That's an excellent yearly return on any investment, almost 30% there. So yeah, that's a great investment. And anyways, thanks for watching. I think Alibaba is a great growth investment, but it's a very long-term investment. That's my opinion. It's not going to be a short-term. It's going to experience a lot of short-term, I guess I just want to say a lot of short-term volatility, and it's relatively probably going to trade flat till its next earnings report or until some great news comes out, with regulation definitely being a fear and a risk that you have to keep in mind there. However, over the very long term, I do think Alibaba will continue to grow. As we've seen, it's raised its guidance. Its guidance is very healthy. On top of that, its fundamentals are healthy. On top of that, it's just continuing to grow its revenue year over year. And its monthly active user base is so massive. And even though its cloud revenue growth slightly slowed down the past quarter, it still is growing overall. And I think that's going to continue going into the future. Anyways, thanks for watching. Please subscribe. Twitter.com/StockerFinance. Check out that. Got some good tweets going on. Check out these videos as well. Newsletter link will be in the below. It's a once per month newsletter. Not going to spam you or anything. It's just once per month. Really entertaining. Anyways, guys, this is StockerFinance. I'm your host, David Scheuer. I'll see you in the next video. Peace out.